Hello, I'm Sam Stovall, U.S. Equity Strategist for S&P Global Market Intelligence. In this week's Sector Watch, I discussed whether the S&P 500 Dividend Aristocrats was still worth owning. When something appears to perform so well for so long, investors invariably ask, is it a bubble? And the same thinking has been applied to the S&P 500 Dividend Aristocrats. Well, to paraphrase former New York City Mayor Fiorello LaGuardia, investors need to get the facts straight before they distort them. Since the inception of the index in 1990, the S&P 500 Dividend Aristocrats have beaten the S&P 500 in 54% of calendar years, which is not an unsustainable pace. And from a valuations perspective, the aristocrats have historically traded at a 2% premium to the S&P 500. Today they trade at a 7% premium, which is slightly higher than its long-term average, but well below the 20% premium peak reached in December of 2011. Finally, in every instant but one since 1990, investors rotated toward high-quality stocks in general and the Dividend Aristocrats in particular whenever the S&P 500 slipped into a correction or bear market. Despite the market's recent bounce, 2016 S&P 500 earnings per share growth estimates have shrunk from 7.4% to 1.2%. And the S&P 500 is now trading at 17 times projected 12-month earnings per share versus its long-term average of 16 times. What's more, with the bull market now in its 8th year, markets are likely to remain challenging. As a result, S&P believes investors should continue to favor attractively valued stocks with proven track records of raising earnings and dividends. I'm Sam Stovall, and I'll talk to you again next week.